Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is January 8th. Today we are going to take a look at a foreign company out of the consumer discretionary sector, Alibaba.com. Let's jump right in. If you are new to the channel, go ahead and hit that thumbs up. Hit the subscribe button down below. Join us on this journey to financial freedom. Join the Vested Interest community and hit that notification bell so you are notified whenever we put any new content out so you don't miss any new videos. This is the Vested Interest Stock Screener. This is how I set up the videos. It's also how I look at a company like Alibaba and see if it's something that I want to invest in. If it meets the metrics, 5 out of 8 or 6 out of 9 if it's a financial company, then it goes onto my watch list and I do a deeper dive into the financials to see if I want to add it. I also do a discounted cash flow analysis to see what I'm willing to pay for it. And this is also what I use to look at existing positions into the already in the portfolio and see if they still meet the criteria that I'm looking at. And if they don't, then I do more of a deep dive and see what's going on with the company. Now, if you want to know more about this company, check them out at www.alibaba.com. That's www.alibaba.com. That is their homepage where I pulled this information from. About Alibaba.com. Launched in 1999, Alibaba.com is the leading platform for global wholesale trade. We serve millions of buyers and suppliers around the world. They are very similar to an Amazon. They are the Chinese version of Amazon. One-stop sourcing. Alibaba.com brings you hundreds of millions of products in over 40 different major categories, including consumer electronics, machinery, and apparel. Buyers for these products are located in 190 plus countries and regions and exchange hundreds of thousands of messages with suppliers on the platform each day. 40 plus categories in their sales, 190 plus countries, so they have a footprint around the world, and 100 plus K messages, so they are in the messaging data collection business as well. Very similar to Alibaba, cloud-based platform as well. So they have a very, very similar overall business model to a Amazon. That's really what this company is. It's pretty much China's version of Amazon, Alibaba.com, right? That's what they do. Now, the reason we are taking a look at them, down 0.18% on the day, and also it is a recent addition to my portfolio, so I thought we would do a review of it. We are talking about Alibaba Group Holding Limited, ticker BABA. They are out of the consumer discretionary sector. Closed out the day at $72.88. Looks like they're slightly up in the after hours whenever I pulled this information. 52-week range as low as $70.08, as high as $121.30. So they are much closer to their 52-week low than their 52-week high. Average volume of 18 million. Today's was 21, so a bit of a sell-off today, even though it wasn't significant sell-off. Market cap of 183.174 billion, so a very large cap company here. Beta of 0.55, less volatile than the overall market. Price to earnings ratio, very low, especially for a company like this. $10.25 per share. Earnings per share, nice earnings per share. High on this one, $7.11 per share. Earnings date somewhere between February 21st and February 26th. So if you're interested in earnings call, look for that. For dividend is $1. They only pay out once a year. We'll see that here in a little bit. They are a recent dividend payer. This next one that they pay out will be their first one that they pay out here in January. Low starting dividend yield, 1.37. And unfortunately, as we'll see, we do not have anything to compare and see if their dividend is going to grow over time on this one. Ex-dividend date was December 20th. They are going to pay out on January 18th. So if you owned them December 19th or before, you will get this dividend payout on January 18th. Now, I like to get into statistics, look at the dividend yield theory. We won't really be able to do this one because they haven't been able to pay, or they haven't paid dividends for 5 years, but let's look over here anyway. Typically, you'd go into statistics, you'd go down to dividends and splits, you'd look at their 5-year dividend yield average. It's not applicable because, again, they have not been growing or even paying a dividend for 5 years. So we're just going to have to go with their 1.37% dividend yield. That's all the information we have. They don't list a payout ratio. We'll see what stockanalysis.com lists as their payout ratio. This probably just hasn't been updated yet. So we can't say based on dividend yield theory whether they're overvalued or undervalued on this one. So that would be a strike against them if you're looking at the metrics that I use. Now, you want to get into the financial of any individual company. Lots of good information here. You're going to see their balance sheet, their income statement, their debt to equity ratios, their margins. Are their margins growing over time? Are their revenues growing over time? Are they paying down debt or taking on debt? Right? Are they issuing shares or buying back shares? All good information that you want to look at under financials. Really understand the balance sheet and income statements of a business if you are investing into an individual business. For this particular exercise, we're going to look at free cash flow. Typically, when you have a company that pays out dividends, if they have growing free cash flow, which is used to pay down debt, repurchase shares, reinvest back in the company, or pay dividends, free cash flow growing means growing free dividends typically. Now, 2020, they were at 180 billion. Big jump up in 2021 to 231 billion. They also started repurchasing some shares here in 2021. Looks like a bit of a drop down in 2022 to 142 billion. But if you look, very aggressive in the share buybacks here in 2022. So this will definitely account for this, what looks like a drop in free cash flow with the repurchase of their own shares. 2023, back up to 199 billion and another increase in the repurchase of capital shares. And it looks like so far, must be in Q1 of 2024, they're at 178 billion. They haven't said whether or not, I do believe they are going to continue repurchasing shares this year. What that looks like, I don't know that they've announced that yet. You want to look to see if they have announced that repurchase plan for this year yet. Overall, from 2020 to date, definitely growing free cash flow if you account for the repurchase of capital stock in that as well. Now, I always recommend more than one source. So another one that I like is stockanalysis.com. We saw yahoo.com on the previous page. You pick any sources that you like. Just make sure you're picking more than one so that you can make sure the information you are getting is accurate and up to date. Now, the 20 stock analysts that are taking a look at this call it a strong buy. They have a low estimate of $90. It currently sits 23.49% lower than their lowest estimate. They have an average estimate of $137.25. That would be a 88.32% increase in the price if it hit their average estimate. And a high estimate of $220, which would be a 201.87% increase in the stock price. All the while, you could collect that 1% dividend yield along the way. Again, they only pay out once a year. They are an annual payer, only one payout in January. Now, same thing, you want to get into statistics here. I like to look and see how financially efficient a business is. To do that, you look at return on equity and return on invested capital. I like 10% or better. If you look at the metrics we looked at in the second slide there, in the very beginning of the video, you'd see I like 10% or better for both of these metrics. For return on equity on BABA, it's 13.20, so it beats the 10% I'm looking for there. Return on invested capital is just a tick under at 9.17%, but overall it doesn't meet the 10% I'm looking for. EPS growth, again, if you go back to that second slide and look at the vested interest stock screener, you'll see I like to look at EPS growth as well. That's earnings per share growth. I like 5% or better. This is set to grow at 22.92% over the next 5 years. That's smoking high for any company. That's very, very good. And they estimate revenues to grow at 7.72% over the next 5 years. Again, very good numbers overall for this one. That's part of the reason I like them. Again, you'd want to go in and look at more. Don't just buy because a bunch of analysts say to buy. Really understand the business, what they sell, how they make their money. On this one, I have chosen to buy this and add it to the portfolio. I have actually been investing in this company for a couple years in another account before they paid dividends. I was basically using this as a way to generate revenue into my dividend portfolio, and I was basically buying in the 70, 80s, letting it run up to the $110 range, $110 range, taking that profit and dumping it into dividend growth stocks. And I did that several times over the last couple of years. I think I made a few $1,000s on it over, just 40 shares here and there, doing that same thing. It's dropped back into the 70s again, but now they are paying the dividends. So that is part of the reason I'm adding it to my portfolio. So I'm familiar with this company. I've been watching it for a couple years. I got into it after the big drop. A lot of people were buying this back in the $200 range. Even I think it hit $300 at one point 3 or 4 years ago. I was not buying it there, but a lot of people were. Even I believe Warren Buffett's right-hand man there, Charlie Munger, was buying it up there. But that doesn't mean that's what it's worth. That's just what a lot of investors were buying it at the time. Now, on to the dividend payout. Again, payout ratio here, stockanalysis.com is listing it at 13.93%. So very low payout ratio. So even though it has a low starting dividend yield, very low payout ratio overall, they do not list a dividend growth because, again, this will be the first dividend. December 20th was the ex-dividend date. They are going to pay out $1 per share, and that is payable on January 18th. I'm assuming, now I'm making some assumptions on this one. I'm assuming they will either leave this dividend flat or they will increase it next January. We will see. I will probably run this up to about 100 shares, maybe back off and give it some time so that we can see what's going on with the growth of the dividend overall. But I am comfortable investing in this right now. And if they don't grow the dividend or cut the dividend, this may be another play where it's a short-term play where I buy it in the low 70s, let it run up to the $100, $110, sell it, take that capital that I made, and then reinvest in a dividend growth stocks. But for now, I'm going to be adding it. Anything under $80 per share, I'm going to be adding to this one here. Similar to Kroger, which I'm just about to build out to 100 shares. I will continue to add as long as it's under $80 or my cost basis is under $80 up to 100 shares on this one. Well, that is it for this one. Always appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, hit that subscribe button down below. Join us on this journey to financial freedom. Join the vested interest community. I cover stock pick of the day videos like this every Monday through Thursday. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company you'd like me to review in the stock pick of the day series, go ahead and drop it down below and I will work it into the rotation. Let me know what you think of this video. Do you invest in Baba? Are you avoiding Chinese stocks? This is a Chinese company, so there are some tax implications around it. Completely understand there's also some probably political risks. If we continue to have issues with China or we're going to war, God forbid we go to war with China, then obviously there would definitely be some political ramifications for this one. They may even pull it off the market altogether for American investors. But for right now, that is not the case. So again, I'm going to invest in this one so long as my cost basis stays under 80, up to 100 shares, and we'll see what happens with it overall. But there are some risks involved in foreign company stocks, not just Chinese stocks, any stocks for that matter. American stocks pose risks as well. I'm not risk averse. You have to decide what your risk tolerance is and what you are willing to invest in. We all have different investing strategies. Stick to your plan. Don't invest in something just because I'm investing in it. Well, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, drop a comment down below. Let me know what you think of the video, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk you can't money. You should never invest any amount uncomfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.